firmly have it. Let's welcome Schwab's Chief Investment Strategist, Liz Ann Sonders, and the founder and CEO of Trivariate, Adam Parker. He's also a CNBC contributor. Both are with me here at Post 9, which I'm so thrilled about. It's nice to see you both.
Nice to see you too.
Liz Ann, so you first. What's going to happen tomorrow? What's the chair going to say? Is he going to rain on this market parade or keep it going?
That's the open question. Whether he does it overtly by actually raining on the parade and pushing back against the expectation of cuts starting possibly as early as March, or he just maybe gets at it by citing what has already been a massive loosening in financial conditions. In fact, it was a record single month in November.
Well, because rates came down so much?
And he may hint that that's doing some of the prospective easing. So that's, to me, what I'm going to be focused on, is whether he sort of does the opposite of what he did when he said that the move up in yields had done some of the tightening for the Fed.
What about you, Adam? What are you looking for? Anything upsetting to the pretty sanguine sort of environment that we suddenly found ourselves in?
Yeah, I don't look at it that way. I just look at it like you don't even want them to cut rates. You want to dream that they could do it. The specter of doing it is a lot more exciting. I could see the market actually selling off when they cut.
What if they cut for the right reasons? I mean, you're assuming they cut because they have to.
There are no right reasons, right? The right reasons would be the economy is in bad shape. And
no,
it
isn't if the inflation's come down enough and the economy's doing pretty well.
I'm not a Fed genius like everyone else on this program has been for years. What I'll tell you is what I learned back in the day is full employment, stable pricing. Which one looks so bad they need to start cutting rates like crazy? Which one looks so bad they're going to have 5 cuts by January 25 or whatever's in the price? What I think the bull case is, you think gross margins can expand for the average stock, and you dream that there's a combination coming someday without it happening. To me, that's the sustained Goldilocks we've been in. That's what I'm rooting for, is equities go higher.
Well, what about the idea, though, that the economy stays reasonably well, inflation continues to trend lower year over year? Of course it is, despite a month, 0.1% pop in November, that the Fed actually can cut for the right reasons, that inflation has allowed them to do that. They don't have to because the economy is doing just fine.
But if inflation is still above their target and their other mandate is not in the clear spotlight, meaning the labor market hasn't deteriorated, Powell has been really clear about not wanting to repeat the mistakes of the Burns era and declaring victory prematurely and then easing and letting inflation out of the bag again. So I think it's going to be the labor market that dictates the point at which the Fed goes from pause to pivot.
Has the rally from November to now and how it's become more broad, more recently, has it surprised you?
No. In fact, I think it was a necessary ingredient for sustainability of the rally. You and I talked about it right around the 1-year point off the October lows, and it wasn't looking great then. Small caps were anemic. Banks were still in negative territory. The concentration problem. And now you've just kind of had this stealthy rotation where you ease some of the excesses associated with the concentration without the bottom falling out all at once. So far, so good. It's nice to see that.
Yeah, I mean, there's a statistically significant relationship between the change in the CPI and the change in gross margins for the average company. So when CPI ripped higher, it hurt profits and it relatively hurt the small caps. We know the big 7, they didn't really get affected by rising CPI. They have a whole bunch of pricing power and other strengths of being big. So if you want the market to rally and you want a sustained broadening rally, you need to believe gross margins are going up. So that's where I spend most of my time with my clients. Is it lowering input costs? Is it productivity? Is labor, increases less of a problem? Is it materials that are logistic? Like, which companies can beat gross margin expectations? Those are going to be the winners next year.
Do you feel like it's time to be more bullish overall?
We talked about this last week, and then I went home and self-loathed because I was responding to the incrementally bullish. And I've been bullish the whole year, so I'm like incrementally bullish, up 35, 40 NASDAQ, up 20, 21, 22 total return S&P. Incrementally? I don't know. You want to be bullish the whole time. I don't think we're going to have as much upside in the next 12 months as we had in the last 12. So you're talking to somebody who looks at the word incrementally and says no, because incrementally it won't be as much upside. Am I optimistic? Risk reward? Yeah, I think so.
But we didn't have that much upside over the last 12 months in a large part of the market. We had most of it in the top-heavy part, and only of late have we started to kind of catch up a little bit. Not even that much.
Nobody who allocates to an equity manager gives them that break. Okay, their benchmark's the S&P. It's up 22 total return or whatever it is, that's what they're compared against. So I think what people want when they charge high fees is they want the broadening rally so they can get in there and find alpha on smaller names. It's hard for them to know stuff about the big seven nobody else does. But I'm reacting to the overall indices being up this much and saying, right, am I incrementally more excited? No. Do I think the risk reward could be? Look, I hate romanticizing about contrarian. Everyone says I'm contrarian, then they repeat the consensus. I do think that the risk reward could be skewed to the upside next year if the average stock gets more margin expansion and if we start believing earnings could grow 3, 4, 5 years in a row. And if that's the case, things look optically expensive now, but middle of 24, you'll be saying, maybe 25, 26, it looks cheap. And that's the recipe for a bigger rally than people think. And I think that's the tenor of your question.
I mean, there's so many people ask you that question. Should I become more bullish? I mean, based on what your company does, is it time to be more bullish in the outlook for stocks or not? We've come a long way. Market's done really well of late. It was very top heavy. Now it's broad. Is it believable?
So tell me what the bond market's going to do, and I'd be able to probably tell you what the stock market's going to do. I still think bond yields are, for the most part, in the driver's seat. We have a negative correlation between yields and stock prices. I think a plunge in yields from here, assuming it reflected a much weaker economy, that would be a digestion phase for the market. But even stabilization in yields, I think, would represent a positive backdrop. On the upside, then I think you have the risk of another July to October.
Do you worry about that, though? I mean, or do you think that rates have they've come down a ton since, in the last 6 weeks? I mean, they're 5%. They're down like 80 basis points.
The question is it true that the last mile in terms of getting inflation down is going to be the trickier one? We don't think, we think inflation will continue to come down, but probably not in a straight line. And you've got, obviously, the energy swing factor, which impacts headline inflation, not core inflation. But I agree with Adam. I think a scenario in which the Fed is actually cutting as soon as March is not a good scenario in terms of what is probably going on in the economy.
That seems a little bit ahead of ourselves anyway.
Yeah.
Right, when the market was saying March and the probability started to go up into the high 30s, you're like, really? Now, obviously, it's backed off that, so we're at June. That makes sense?
Well, this morning it was still 45% probability of a cut in March. I think that's pretty sure.
I think I saw 5 cuts by end of next year. So to me, the economy and corporate earnings have to get much worse. And I don't think everyone's going to just, whistle by that graveyard the entire year. So I don't think you want things to get like that. I think you want to believe earnings can grow a little bit, and there's someday they'll be more accommodative, and that's the cocktail.
Hey, there are some people who think earnings are going to grow a lot. I mean, I've had very bullish people on this set.
Well, the consensus suggests that, but I think the consensus is not realistic. And I don't mean it's too high. I just think what's happened in this unique cycle, and it's a vestige of the worst part of the pandemic when analysts were getting no guidance from companies. Now I think they're adjusting estimates much nearer term. You'll get into earnings season, they might make an adjustment to 1 quarter out, but they're not making those adjustments. So I'm not sure how valid the calendar year 2024 estimates are. They haven't moved. The quarterly estimates are moving up and down a lot. So I'm not sure it's valid valuation analysis using a calendar year number for 2024.
Yeah,
it's not based on reality.
I don't think it actually matters. What matters is, do you believe earnings are going to be higher? Right? Because on average...
Well, do you believe they're going to be double-digit higher? Because that's sort of where we're thinking.
Yeah,
that's what the market's betting.
The consensus is 11. I don't think that's right. I think it'll be mid-singles or maybe a little bit higher, maybe 6-7%. So I think 11's too high. If you look back, I think forward earnings data have existed since 1978. On average, in January of each year, the analysts grossed up to 14% expectations. The actual's been 7%. Obviously, the market's gone up a lot of those years since 1978. So I think she's spot on. It's not the downward revision that matters. It's as long as it's being downward revised, you think the growth is still going to happen. Markets can do okay in those conditions.
Did I hear you making the case for small caps?
Smaller. I think there's opportunities, but stay up in quality. I would absolutely fade the low quality areas, just smaller. I think there's opportunities. I think there's a lot of active money, both professional and individual, that is itching to find opportunities outside just the Magnificent Seven. Continue to think you want to be much more factor focused than sector focused. Strong ROE, strong free cash flow, interest coverage, profitability. And I think that's the way to approach it. And there's opportunities down the cap structure. I wouldn't index to a Russell 2000. There's no profitability filter, still 32% zombies. But I think there are opportunities outside of the mega cap names.
Speaking of like energy, which you've liked, are you still on that train, or are you about to hop off?
No. Two things. One, I parse the quality thing a tiny bit, which is I think in growth stocks you want high quality. And that's 2/3 of the battle if you're trying to beat the S&P.
A lot of the other stuff has rallied a ton, though,
I think
in growth.
And think in value stocks, you don't necessarily over time want high quality. You want future quality that doesn't look like it today. So when you define it systematically, you don't want quality across the board. You want growth quality over time. In terms of energy, look, my view is that we're short being able to produce 107 million barrels in 5 or 10 years, and the path toward getting there is unclear. So I think ultimately demand will exceed supply. The thing that worries me tactically is the same thing what worries everyone else, which is Hess sold to Chevron without a premium. And so when you start thinking about it, he probably knows his assets better than they do, and he probably thinks he can sell it without damaging Chevron stock as much as damaging his own. Like this, underneath tactically, it's not great, but I don't see how we get 107 million barrels down the line. So ultimately, we're going to have much higher oil, but the path from here to there can always be filled with 19 hard to predict variables. So I like it long term, but I have no idea about 3-month view.
But when you're talking about quality growth, so I know we've been obsessed with the Magnificent Seven, and the performance has been incredible, but of late, all those other growth stocks have done incredibly well. Like the ARC type names they just had their best month ever in November.
Right. Well, when the bond yields come down, she's spot on. You had the highest correlation you've had in years between negative if you look at yields versus equities. What happened is all the riskier companies where more of the value is way out in the future, they go up because their cost of capital came down.
Sure, but what if rates? What if rates stay low?
So
lower.
Look, we didn't pre-prepare, and I usually disagree with people, and it gets a little awkward. In this case, we agree a lot because I think if they plummet, it's because the conditions in the economy got much worse, and it's really a risk.
If rates plummet,
if the 10-year yield goes to 3 or 2.5 in a hurry, that's because things get bad.
Well, of course,
if it stabilizes where we are here, and maybe the 2-year comes in, you uninvert eventually. That I think could be, very supportive of higher multiples for equity. So I think that's where, I agree. If you can tell me the exact mapping of the 210 level and slope, I could probably do okay picking stocks.
What about one thing we have to do though? Anytime we talk about growth and value, explain what you mean by growth and value. Are you talking about indexes? Or are you talking about the factors of growth and value? If you remember, we may have talked about this mid-December last year when S&P did their rebalancing. The mega cap 8 were all in S&P's pure growth index. On December 19th, the day of the rebalancing, only one was left in the pure growth index. Tech went from being 37% of that index to 13% of that index. Energy became the highest weighted sector in S&P pure growth. In part because of that, Russell 1000 growth is up 37% year to date. S&P pure growth is up 2% year to date. So when people just say growth and value, I always think, what are you talking about?
You
are you
yell
talking
at the
about
TV.
the characteristics? Are you talking about our preconceived notions of what are growth and value? Even if you're talking about the indexes, what indexes?
Yeah, we're at Trivare, we're nerds, right? It's all systematically assigned. It's mutually exclusive and exhaustive, and you can't both be in growth and value like Russell used to have with Exxon or whatever. So for us, it's not that shocking. I mean, if you grow fast, you don't have a dividend, you don't have any debt, you're expensive, you're a growth stock. So it's all systematic, but it's probably pretty correlated.
The problem is that if you're not a growth stock, you're put in a value index. You don't necessarily offer value.
It's funny,
You're just not a growth stock.
We do it for this reason in thirds. We have like a growth, neither, and value, because I think that neither zone is a little bit different. So I think we're getting the same answer, maybe showing our work a little differently on the path.
What's the point at which, Lizanne, I'll ask you first, that money comes out of money markets and then goes into equities, and that sort of spurs the next leg of whatever kind of market, whatever kind of bull market this may be, if in fact this can hold up?
But
are we approaching that point?
But equity flows have been strong too. So I'm not sure a lot of the money in money markets is the traditional sideline cash that's itching to go into equities.
Even this time where that there was so much money in cash?
That has come from maybe other areas, typical deposits, other areas even within fixed income or the equity market, where a lot of income-oriented investors are saying, now I can actually get 4 or 5% in a money market. There was that sort of similar size in relative terms of capital in money markets in the 90s, and it didn't leave, but you had a strong equity market and you had sort of this meaty amount of money in money markets. And I'm not sure we should necessarily think of it as some moment in time source that's going to fly into the equity market. I think it's probably pretty sticky.
The world's so much different than it used to be, where you could really bank on these flows from a cross-asset allocation or regional allocation. I mean, pick one multi-strat or pod shop. Pick any one. They have 35 quant teams. Those teams are running 600 to 1,200 gross exposure, hundreds of longs, hundreds of shorts, and they have 3-hour to 2-day holding period. Like, that's what's happening.
Yeah, but I'm saying maybe this time is in fact different. Like, we know that because rates were so elevated that putting your money in a money market where you could get 4 or 5% was so much, the risk reward on that was so much higher than taking what seemed to be a tremendous risk in equities because of the Fed's regime of hiking. So if we know that there was an outsized amount of money that went into money markets, if the coast is deemed clear, why wouldn't that money go in? And by the way, maybe it goes to bonds too, if you think that yields are going to continue to come down and bond prices are going to go up.
Yeah, I mean, I think there's two different issues. Like, it's all horizon, right? I mean, I don't know any actual human being who buys the 10-year and holds it to duration. I mean, unless...
At Schwab, we do.
Well, my clients are like people who are institutional equity investors with a 12-month holding period, or
Take
so
that.
Right. But at Schwab, when you run like 40 trillion or whatever, and then there's going to be trillions that are holding it. But like, to me, I could see somebody saying, I'll buy it tactically or something, or I could see holding the 2-year or something like that to duration to pick it up. But to me, that's like a small part of what's... You asked about inflows into equities driving a much bigger equity market.
Right.
Also, keep in mind, though, for all the talk about the record amount of money in money markets, as a share of equity market total capitalization, it's fairly small. So the firepower has to be judged with that ratio in mind, not just the dollar level of what's in money market funds.
I'm going to leave it there. You guys were great. It was so much fun having both of you here in the house. Liz and Sonders.
Happy holidays.
Yeah, of course, to you both as well.
Thank you.
Thank you. We'll talk to you again soon. We're just getting started here.